Hello and welcome to another video from Simple Invest. So this is actually the second time that I've done this video. This is a video regarding the investment quiz that most Americans reportedly failed from CNBC. So it was first reported by CNBC on the June 29th of June. And some of the YouTubers, I believe, I watched Wealth Hacker Jeff Rose YouTube channel. He actually did a feature of it, and it piqued my interest. So I decided to do my own take on it, answering, like going through the questions itself, and also giving my version of the answer, my version of my explanation of the different answers that are for that 10 different quiz questions. So like I mentioned, I actually did this video recording before, but it was a 30-minute recording. I only realized after I finished recording the video that I was muted for the entire duration. So here I am doing a second take, re-recording everything again, and let's get to it. So this quiz, as you can see on screen, the average American scored an F on this investing quiz. It was first reported by CNBC.com, and it was originally published on grow.acons.com. So let's watch it from here. Okay, so moving on to it. Question 1. Which best describes your understanding of compound interest? So best is to use a calculator. Okay. So compound interest, okay, to give some perspective on it, I did get 10 out of 10 correct for this particular quiz, but it's, so this is just my version of explaining it to you, the viewer, who, for you, if it's the first time you're going through this quiz, I would suggest that you take this quiz yourself. You can go to cnbc.com, just Google for the average American scored an F on this investing quiz. You can Google for this headline, and you should find it on CNBC, or you can find it on grow.acons.com, and you should take that quiz yourself before you watch the rest of this video to go through my version of the answers. Okay, coming back to here. Question 1. Which best describes your understanding of compound interest? Let me take a sip of water. Okay, water is important. So compound interest, basically it's interest that keeps compounding when you grow your money. But it also works the reverse way. When you keep losing your money, it also works reverse. So compound interest is a double-edged sword. But let's assume that you're investing in something that keeps growing every year. For example, if you're invested in a stock index that grows at 10% per year. So let's illustrate. If you have $100,000 and your money grows at 10% this year, so that means by next year, let's multiply by 1.1, the 100,000 would become 110,000. Pretty straightforward. But what if it grows by another 10% in the following year? So how compound interest works is that 10% will be based on this 110,000, and it's not on your original 100,000. So in fact, the second year, when you get that second 10%, you gain more. So very simple. Let's multiply by another 1.1. So after 2 years, your 100,000, after compound interest of 10% for 2 consecutive years, now becomes 121,000. So it's not too bad. That's slightly more than just 20% gain after 2 years, because you get an additional 1,000 due to the compound interest effect. So how about let's do it for maybe let's grow by another 10% for remaining 8 more years, right? So multiply by 1.1. So there's third year, and after the fourth year, after the fifth year, sixth year, after seventh year, eighth year, ninth year, and 10th year. Okay, so after 10 years, you have grown to 259,000. So there's another easier way to calculate compound interest, which is using the power symbol, because it's a scientific calculator. So pretty straightforward. So let's take 100,000, and let's assume you get compound interest for 10% for 20 consecutive years. So I take 1.1 and I click this to the power of 20. Okay. So you can see here the formula is here. 100,000 multiplied by 1.1%. That means 10% compound interest for 20 years. From 100,000, it becomes 672,000. How about what if I keep that money rolling for compound interest for 30 years? So let's do it again. 100,000 multiplied by 1.1 to the power of 30. So it becomes 1.7 million. So in other words, if you had invested 100,000 into an asset that is growing at 10% compound interest and you have kept it rolling there for 30 years, your 100,000 will have become $1.7 million, which is a pretty good gain. It's way better than just saying that gaining 10%, because if you just take 10% multiplied by 30, I believe that would have only been 300,000, right? So if the interest was not compounded, 100,000 multiplied by 300,000, you have only given you, sorry, uh, yeah, 100,000 multiplied by 300% would have only given you 300,000. But now in this case, if you have compounded the interest over 30 years instead, you have become 1.7 million, which is a lot more than just 300,000, many times more. So this is the effect of compound interest, and this is what compound interest is. Okay, so hope that illustrates your understanding. Moving on to question 2, what is the S&P 500? So S&P 500 is actually an index. Let's go to maybe Bloomberg and just search for S&P 500. Let's see whether there's, okay, we have, here. So S&P 500 is actually an index. So an index, basically, it's for this S&P 500 particular index, it lists the top 500 companies on the American Stock Exchange, and this top 500, they are ranked in terms of their market cap. So how much total worth is all the stocks in that particular company? The top 500 of these companies are ranked, put into the S&P 500 index. So the S&P 500 index, I think they have some sort of weightage system that probably the bigger market cap companies probably weigh a little bit more. I don't think they're all even. So I believe they are weighted based on market cap, and it's a pretty fair assessment. So S&P 500 index basically gives you the advantage of being able to track the general movement of the market. So if you want to know generally what the American stock market is doing, all you need to do is just look at the performance of the S&P 500 index. So it gives you a pretty good indication. Okay, so S&P 500 is an index of the top 500 companies in terms of market cap. Let's go into question 3, true or false. When you purchase a stock, means you're a partial owner of the company. So this is true. The answer is true here. Because what happens is when you purchase a stock, let's say, I like to use Apple, AAPL, which is Apple Inc., the company that makes iPhones and Macintoshes, right? So when you purchase a share in Apple, you are part of the ownership of Apple for a very small percentage. So some of the perks of being an owner is that you get to take part in capital gains. So example, when the share goes up, then your value of the company increases proportionally, right? Because you own the exact percentage of the company. And as a partial owner, you also get some companies will give you voting rights in terms of annual general meetings. So I believe that was AMD, because I also own AMD stock. So Advanced Micro Devices. So AMD is a company that makes computer chips, and they are doing pretty well these few years. They're on an uptrend. So their direct competitor will be Intel, which also makes desktop computer chips. So for example, I believe I own AMD stock, and there was once, I believe, few months ago, I received some notifications from my stock brokerage that AMD is holding an annual general meeting, and I have actually voting rights. So I went to their website and I checked out my rights. So I can actually decide to vote on whether to keep Lisa Su, which is their CEO, as the next CEO for the next financial year, or I could also vote any of our competitors. So they have a list of who are the potential CEOs to replace Lisa Su if Lisa Su was to be dethroned by the annual general meeting vote by the shareholders and the directors of the company. And they also give you voting rights for, other than the CEO, other important executive positions in the company. I believe for AMD, we also had the right to vote on who is the next, or who is going to be the next year's CFO, or a chief financial officer, and stuff like that. So, and you get the vote on the board of directors as well. Like they will give you like, these are the board of directors, executive board of directors, and should we vote to keep this person? So yeah, yes or no and stuff like that. So yes, so as a stock owner, you do become a partial owner of the company. Question number 4. What is a dividend? Okay, so the answer here is money paid by a company to its shareholders. So it's definitely not the rate at which interest compounds. That is compound interest. The difference between what you bought investment for and what you sell it for is called capital gains. Okay, I'm gonna take another drink. Thirsty. All right. So a dividend is money paid by a company to its shareholders, but this is different from capital gains, which is this answer. Basically, let's say I'm not sure whether AMD gives a dividend, but basically it's for example, let's say I've owned AMD stock for 1 year, or I owned it before the dividend paying date. Then AMD announces that they will give a 1% dividend. So how much, uh, however much I've invested in AMD, let's say I invested $100. So AMD decides to give, that means I bought around 2 shares, for example, because now it's around $50 per share. So I bought 2 shares and I have invested $100. AMD announces a 1% dividend. So once the dividend date has been reached, I will be credited $1 extra. So, and actually the stock price will be adjusted down by that 1% as well. So you do see an adjustment in the stock price. But basically, that's what a dividend does. So a dividend is separate from capital gains. So some investors find dividends pretty attractive because, for example, if I'm a long-term, let's say a company keeps giving dividends of 1% every year, and it's also growing, its share price is also on the uptrend. So I get, not only do I get the benefit of capital gains in the share price, I also get the benefit of additional 1% dividends every year. So so it's good. I mean, it's free money, kind of, in a way. There'll be another question later that explains like the downside of dividends, I guess. So how is a company share price determined? Okay, simply it's determined by the supply and demand in the market. The Federal Reserve in the United States only decides monetary policy, so it does not determine the share price. Company board of directors does make important decisions in terms of the operations and what the company does, direction of the company, but also does not control its share price. They will wish they can control its share price because they benefit. And the New York Stock Exchange is simply a stock exchange where the companies list their stock. So it's just like a board, or it's just a place, and it's like a non-physical space where companies list their stock on. That's called the New York Stock Exchange. The other stock exchange that's popular is called the Nasdaq, which a lot of tech companies originally listed their stocks on. Okay, and yeah, so basically that's it. So how a share price is determined is basically by supply and demand. Okay, so I will use the calculator to illustrate. For example, we have here AMD stock. Let's say AMD stock, probably, do we have like 1 year ago, right? Okay, let's view the full chart so I can see the share price here. Okay, so you can see that AMD stock in, when was this? October 2019. It traded at around $30, right? So it traded at $30. And when it came to November 2019, the share price went up to around $40, around here. Okay, let's see. Okay, because this is the $40 line, so it traded at $40. So I bought AMD shares, for example, let's say, imagine I bought AMD shares when it was $30 back in October 2019. And when it was in November 2019, it went up to $40. So I sold my share at $40. So at that time, the market price becomes $40 because there was demand for it. and now the share price becomes 40. And if I held it, so that is person B bought AMD share at $40, right? So moving on forward to in 2020 February, the share price went up to $55. P was 58 here. That means somebody was willing to buy the share at $55. So person B bought his share for $40 and now sold it at 55 to person C. And person C now is a willing buyer at 55. So the price of stock goes up in this way by buying and selling in the market. So by simple supply and demand. So basically saying that if there's somebody that's willing to buy the share today at 55, and tomorrow there's somebody willing to buy it from person C at 56, then AMD share price will have gone to 56. And in the following day, let's say share price has dropped. So nobody is willing to buy AMD shares at 57, but people are only willing to buy the share at 50. So now AMD shares worth is only worth $50. So the share price has dropped. So it's shares are constantly being manipulated by just the supply and demand, by casual investors buying and selling in the market, traders and investors. Okay. Yeah, so that's share price. Question 6, what is the Dow Jones? So Dow Jones is very similar to the S&P 500, but it's not identical. Dow Jones is a way older stock index, and is not the marketplace. The marketplace is the New York Stock Exchange. It is not an investing related podcast. It is not a show. The Dow Jones is actually another index similar to the S&P 500, but because it's a way older index, it was invented way back in, I don't know, maybe a few centuries ago or many decades ago, where there were not that many companies listed on the American stock exchanges. So in order to track the movement of the stock exchange, they only tracked the 30 largest US companies in terms of market cap. So the Dow Jones is actually an index tracking the stocks of the 30 largest US companies. Okay, let's take another drink. Question 7. True or false? Novice investors should focus on timing the market to maximize their investments. So first I want to explain what is timing. Basically, timing is you want to time your entry into the markets. For example, if you had bought AMD shares back in October of 2019, where it was $30, and then you have sold it at the peak of a share price at $58 in 2020 February. So you would have very effectively timed the market. That means you bought it when it was very low price and you sold it when it was a very high price. So another example of like perfectly timing the market was if you have bought AMD shares recent in March 20th of March 2020 this year, when it was around $39 to $40, and you have managed to sell it at April 20th, like in April 2020, when it was at $56. So there's another example where you have perfectly timed the market, buying the share at $40 and selling the share at 56 to lock in a good amount of profits. So this is what we call by timing the market. So general investors, novice investors, we would generally not recommend to time the market, because since you don't have a lot of experience on how a particular stock moves or the particular movements of the stock market, we would just suggest the other alternative, which is do dollar cost averaging. That means invest in the market as and when you have the spare cash, and invest it in regular intervals, let's say once a month, or maybe once every 2 months, or once every 3 months, once every 6 months, and so on. So we call it dollar cost averaging. That means over the span of like 10 years or 20 years, you're just going to be buying into the market as and when you have the spare cash in small amounts. So investing in the market over time as compared to trying to time your entry into the market. Because for novice investors, it's really difficult. Because, for example, AMD shares are now at, let's say, $53. Will AMD shares continue to go up? Will AMD shares continue to go down? And if it goes down, will you be selling at the lowest price? For example, if you are somebody that do not have experience and you bought it at the worst possible time, you bought AMD shares at $58 when you thought it was going to go up. And then when it was going down to the lowest point of $40, you thought AMD shares was going to go lower, and due to fear of losing out even more, you sold AMD shares at $40, and after that, AMD shares went up. So what if you've done the reverse? That means you did uh, that means you had very badly timed the market. So instead of gaining from timing the market, you actually lose more money by timing by being bad at timing the market. So for novice investors, we would recommend for them to not time the market and instead to use dollar cost averaging. Okay, question number 8. What does it mean when a stock has a high price to earnings ratio? PE means price to earnings. We can see PE, I believe here, P ratio, price to earnings. So price to earnings is a measure of the stock price. For example, AMD shares are now at $53 compared with its earnings per share. So this is this 90 number here means AMD shares are currently trading at 90 times its earnings, its per share earnings. So if you take AMD stock price of $53 and you divide it by 90, you will get AMD's earnings per share. So it should be listed here. So AMD is earnings per share is at 59 cents. So now it's trading at almost 100 times its earnings per share. So that's a price to earnings ratio. So coming back to this question, what does it mean when the stock has a very high price to earnings ratio? Stock is expected to increase or stock is expected to decrease? So this is a pretty subjective answer. For this particular quiz, they put the correct answer as the stock is expected to increase in value. So to explain a little bit, for example, if the price to earnings ratio is high, it means that the stock is currently on the uptrend. And I think that what this quiz is trying to say that the stock has high demand. That means a lot of people are trading the stock higher and higher as compared to its earnings, which has not grown a lot. So I believe the question is trying to say that for the people who are, if you see a stock that has a very high price to earnings ratio, it probably means that the stock is on the uptrend. And why it's on the uptrend? It probably means that people or the general investor is expecting the stock to go up in value soon or maybe in the very near future. So this is why it's not expected to increase in value. However, if you subscribe to value investing, which is what Warren Buffett advocates, he is the master of value investing. Warren Buffett and principles of value investing would ask you to buy stock that has a low price to earnings ratio, because their value investing's view is that you want to buy when the stock is undervalued. That means if the stock is currently out of favor from the general investor, if it has gone down in price, for example, at this point of AMD stock, maybe back in October 2019. So when AMD shares were at $30, it probably has a much lower price to earnings ratio. So value investors will have told you to try and buy AMD shares back then when they were low price to earnings, because even though it is out of favor with the general investors in the market, it still gives you a good value because you're buying the stock when it's underpriced. And based on your own analysis, AMD shares has good fundamentals. It might probably go up in price in the future, but maybe in the long-term future, maybe a year or two later. But that is value investing. So that's why this question is pretty tricky, it's pretty subjective. Because if you are a value investor, when a stock has a high P ratio, you would expect it to decrease in value. But if you are a layman trader, that means you are going along with the trend. If you see a stock that has a high P ratio, you are expecting the stock to increase in value. So this question, a little bit tricky, but I'm just explaining to you why they put the answer as the stock is expected to increase in value. Because from the trend perspective, people are buying the stock because it's high in demand. And why it's high in demand? Because people are expecting the stock to increase in value in the near future. So we're not talking about the long term. All right. So moving on, question 9. How long do you have to hold a stock for it to be considered a long-term investment for tax purposes? So this question is very specific to US markets. If you're not a viewer from the United States and you're an international viewer, such as me, I'm from Singapore, this does not apply to me because so far for Singaporeans, or I do not know for residents in other countries, but for Singaporeans who are holding on to US stocks, we are not taxed when we sell US stocks, at least not for now based on US law. So this is the answer for this is actually 1 year, I believe. So for US residents. So this is a very specific US resident only question. And for question 10, do all stocks pay dividends to investors? The answer is no. So the board of directors, which is like the CEO and the other controlling executive board of directors of the company, are the ones who decide whether they would want to give out dividends from their company to the general shareholder. Because, like I mentioned, this is the downside of giving out dividends. Basically, when you give out dividends, you have to take the dividends from somewhere, right? The money has to come from somewhere. So the money has to come from, I believe, if you look at the balance sheet, yeah, it has to come from, no, it's come from the cash flow, right? So when you give out dividends, it has to come from the cash flow of the company. That means the company has to take out from their bank account for example, let's say they're giving out dividends of 1%, and that amounts to like maybe $500 million. So this $500 million has to come from somewhere, right? So the company either has to take a loan for $500 million to give out the dividends to all its shareholders to make the shares attractive for people to buy or for people to keep, or otherwise they have to take that 500 million from their own bank accounts. That means from the money that they're currently holding on to give out to its shareholders. So the board of directors and the CEO might decide, this is not a good move. I mean, giving out 500 million for free to my shareholders, I would rather use this 500 million to invest in like maybe a new machinery, or like hiring more people, or invest in R&D, and so on, to make better products and so on. So the company can decide not to give out dividends. So dividends are not it's not a must, especially when you feel the board of directors and the CEO feels like the money can be better used elsewhere, like in research and development, in expansion, in maybe giving pay rise to their board of directors or their workers, stuff like that. That would be a better decision for the company, right? So do all stocks pay dividends? No. Okay, so that will be the 10 questions that the average American person got an F on. The 10 investing questions that average American got an F on. So how do you perform in this quiz? If you did well in this quiz, or if you did poorly in this quiz, you can answer along in the comments. And I hope this video has been useful to you. So like if you get 10 out of 10 out of this quiz, that's good for you. You're probably an expert investor in terms of the stock market. So do take note that this quiz is all related to US stocks. Of course, most of these stocks are like general facts do apply to stocks for other in other countries' exchanges as well. Like say you're from maybe from China, you're from Singapore like me, or these dividends, things like dividends, P ratio and stuff like that would apply the same way to your country's stocks as well. However, investing is way more than just stocks. So take note that all this, even though they say this is an investing quiz, take note that all this investing quiz is very specific for stocks. But investing can be in other things, like investing can be in real estate, investing can be in CFDs, investing can be in commodity products like gold, silver, investing can be in Bitcoin, it can be in Forex, and stuff like that. And all these quizzes are totally not relevant to all those other forms of investments, right? So it's only very specific for stocks. Okay, so I'm gonna wrap up this video. Thank you very much for watching. Hope you have learned something, and we'll see you next time.